Hi everyone, I'm James Hart and welcome to this Orbex trader education session where we're going to take a look at two of my favorite harmonic patterns to trade, and that is of course the 5-0 pattern and the 1-to-1 pattern. So before we kick off then and take a look at these patterns in detail, let's just quickly first of all make sure that you all know what harmonic patterns are. So for those of you who aren't familiar with the term, harmonic trading or harmonic patterns essentially refer to an advanced form of technical analysis which uses Fibonacci ratios, symmetry, and market structure to identify patterns in the market that can then be used to trade reversals. So what we'll do is we'll jump straight in. We'll take a look at the diagram of the first pattern, the 5-0 pattern, so I can outline what the pattern looks like, and then we'll walk through how it presents itself on the chart and the specific methods for trading it. And as ever, everyone, if we have any questions along the way, please just write them in the chat function, and I'll stop periodically as we go along. And then I'll also leave some time at the end for some Q&A. Okay, so here we can see the 5-0 pattern, and we've got both the bullish version here on the left and then the bearish version on the right. So this might look a little bit complicated for those of you who are new to harmonic patterns, but it really is quite simple. Let me just walk you through what we're seeing here and what all these lines and numbers and letters mean. So looking at the bullish version first then, you can see that the pattern begins with an initial bearish drive from the O to the X. So this is initial bearish drive, and then we get a retracement higher here that gives us the XA leg. So X is always the start of the harmonic pattern. So this first leg is simply the setup into the pattern, but then the first leg is the X to A retracement that we get, and then we get one further push lower, giving us a new low below the low of the XA leg, and this needs to complete into the 113 to 1618 Fibonacci extension of that XA leg. So this gives us our AB leg, and then from here you can see that we get a really strong reversal higher, and we trade all the way up from the lows here, breaking above that XA high, breaking above the higher VO, and we trade up to this C point here, which needs to complete into the 1618 to 2.24% extension, Fibonacci extension of that AB leg. So from here we then get one final move lower. We get this retracement down from the C into the D leg, and this gives us the completion of our pattern, and the pattern needs to complete into the 50% retracement of the B to C move. Okay, so hopefully you can understand that clearly. I know it looks complicated, but it really is quite a simple structure that we're looking at. And so the premise here is all we're seeing is this large reversal from lows to a high point, and then a retracement lower into the 50% retracement of that B to C leg, and that gives us the D point of the pattern, which is of course the completion point. And because this is a bullish pattern, this is the area where we can look to buy. So let's take a look then at the bearish version, which is obviously the same as the bullish pattern, but the parameters are all in reverse. So this time our O to X leg starts with a big bullish move. We then get a retracement lower, giving us our XA leg, which is the start of the pattern. We then trade higher once more, breaking above that XA high to trade to new highs, and this needs to complete into the 113% to 1618 extension of that XA leg. So from this point then, from our new high, we get a strong reversal lower. Price trades all the way down to this C point, and again this C point needs to complete into the 1618 to 2.24% extension of that AB leg, and then from here we simply get one final retracement higher, completing into the 50% retracement of that B to C price move, and this gives us our D point. And again, because this is a bearish pattern now, this is our area where we can look to sell. Okay, so these are the two diagrams. Point A must be on A50. Point D. So the D percent needs to complete into the 50% retracement of B to C. So this large bearish move here, once it retraces C to D, needs to complete into the 50% retracement atom. Okay, so these are the diagrams then, and with that in mind, let's now take a look at how these patterns present themselves on the chart. And as I've mentioned before, one of the key challenges that many traders face with harmonic patterns is getting used to the different ways the patterns can present themselves in practice, because obviously when we show them here in these diagrams, they look very smooth and very neat, and they're very easy to identify. But in real life price action, they can often be harder to spot because of the way that price moves and the inherent noise that's present on the charts. But as with all technical analysis and technical elements, the more time you spend studying the charts and practicing identifying these structures, the easier you will find it to identify them and the better you'll get at trading them. So let's take a look then at some examples, starting with a bearish version of the 5-0 pattern. Okay, so you can see in this example here, we have a classic bearish 5-0 pattern, and this really demonstrates beautifully just how effective this pattern can be for picking out reversals. So you can see that we have our initial move in place from O to X. We get a retracement lower from X to A, giving us the first leg of our pattern. And we then trade up into the highs, into the 1618 of that XA leg extension, and that gives us our AB leg. And then from there you can see we get a move lower down into the CD leg, and that BC leg rather breaks down below the XA low. Okay, so you can see that once we've actually mapped our retracement level, then what we look to do is check that the pattern completes into the 50% retracement of the BC leg. Okay, as you can see here, that the move from C to D actually completes into that 50% retracement level, and so this is how we know that the pattern is actually completed now. And it's important to note here also, you can see that what we've got is a lovely piece of symmetry in the market, because the move from A to B is exactly the same as that move from C to D. Okay, and so we can track this by applying a line. So we can simply draw a freehand tool line onto our chart and track that move from C to D, where we complete into the 50% retracement level. So if you want to check that the price swings are of equal lengths, you can simply draw these lines and clone them to measure it. So again, the pattern then, because this is a bearish pattern, completes, the CD leg completes into the 50% retracement of the BC leg, and this is where we can look to capture our short trades. So in terms of how we actually go ahead and trade this pattern then, we have two options. So the first is we can look to capture a short-term reaction, or alternatively we can look to enter and hold for a larger move. So in terms of capturing a short-term reaction then, if we're entering short at the 50% retracement of that BC leg with a stop above the 61.8%, then we can look to target a move back down into the 23.6% retracement of that move. So all we're looking to do is apply a Fibonacci tool from that BC leg, and then once we've got our Fibonacci levels set up, we're simply looking to trade down from the 50% level down to the 23.6% retracement, and this gives us a roughly 2-to-1 return. Now the beauty of trading the pattern in this way is that generally the reaction will happen very quickly, and so we're able to achieve a positive risk reward in a fairly quick manner, and we don't risk running into a potential reversal, so a counter reversal, when price hits that BC low. Okay, so if we're trading from here short, one of the riskier parts of the trade will be as price tests this low point here, because very often this can be a stalling block where price reverses higher. And so for traders who like to be in the market very quickly and don't like to be holding trades or sitting through chop, it's advisable that you look to target a short-term reaction instead of looking to hold price for a bigger move. Now, in terms of trading the pattern for a larger move then, again, where we enter at the 50% retracement of this BC leg, so where we enter here at our D point, and that's the 50% retracement, we can look to place our stop above the 78.6% retracement, and so this gives us a little more room to let the market move and maneuver. And then what we can look to do is target a move equal to the move that was made from B to C. Okay, and so to do that, all we simply do is draw a freehand tool line, or you can use a Fibonacci tool to measure this move, clone it, and then apply it from the D point here. And then what you'll see is that the target, doing it like this, puts the target down here. Okay, So we're short from this D point here. Our stop is above the 78.6. We've cloned the move from B to C. Now, because we're trading a harmonic pattern and we're using the Fibonacci ratios, we know that if price breaks that BC low, then there is a strong likelihood that we are going to, in fact, trade down to a completion of that D point. So again, using that move as a target, you can see gives us a really nice, much longer return. And in this instance, it would be more akin to 3-to-1 that we'd see on that move. And again, you can see that we actually broke down further than that level and traded lower. But in terms of establishing positive risk reward and looking to trade a likely outcome, this is a really good way to use a target when you're trading these patterns, is to map the B to C move, clone it, and apply it from the D point. So as I mentioned earlier, then the key level to monitor with this pattern is the BC low. So if we're trading short from the D point, we want to watch price as it trades into this BC low. And if we start to see signs that it's likely stalling, then what we want to do is move our stop to break even in case the market reverses from this point and trades higher, because we want to protect ourselves from letting a winning trade turn into a losing trade. So essentially what this pattern represents then is a safer way to trade a counter trend reversal, because all you can see that's happening here is the market was in a bullish trend, making a series of higher highs and higher lows all the way up to this point here before price sharply reversed and sold off. However, instead of looking to get short as price breaks down through those lows, we can wait and watch to see what happens when price trades back up and retest them. Okay, so again, what we've let the market do is tip its hand as to where it is likely headed. So we've traded down, broken down past the low of A, which is the last swing low in this bullish move. We've put in a fresh low in the series, traded back up, and so what we're anticipating is that this D point is potentially going to be a lower high, offering us an entry point to this counter trend reversal, to a bearish reversal lower. Okay, so let's take a look then at an example of how we can establish confluence when we're trading this pattern. Okay, because as I talk about in a lot of the technical sessions that I do, one of the really important things to always be looking to do when you're trading technical elements is to look to establish confluence between different elements. So we've looked in the past at confluence between support and resistance and trend lines. We've looked at using technical indicators, and harmonic patterns are no different. You can combine harmonic patterns with other technical elements to establish confluence to improve the likelihood of your trade working out. Okay, so when we're talking about establishing confluence, then all we mean is looking to find two technical elements that present themselves at the same level. So hopefully then some of you will be familiar with the head and shoulders pattern. So there's a really great example in this chart image that we're using of where this 5-0 pattern lines up with a head and shoulders pattern, which is a classic reversal structure formed by three peaks, a first initial high, a higher high, and then a lower high, which resemble the head and shoulders of a body. So if we take a look then at the next slide, you can see here that these highlighted levels actually highlight the head and shoulders pattern that we have in play. Okay, so price has traded up, put in a high, and sold off. Buyers have stepped back in, driven price higher again, up to this high point at B, where sellers have stepped in again and driven price lower down. Buyers have once again stepped in and driven price back up. However, you can see that we've only made it as high as the first peak this time. Okay, and so what that tells us is that order flow has shifted in the market. So sellers are starting to become more dominant now, and buyers are losing their momentum, and there is a strong likelihood of a shift lower. So once we've identified that head and shoulders pattern, then we can also identify this bearish 5-0 pattern completing at the same point. So the 50% retracement level lines up almost perfectly with that left shoulder. And so once we see price trading up to this level and stalling at the level, we can say to ourselves, right, we've got confluence here between two strong bearish reversal patterns, suggesting that the market is likely to break lower. And this is a really fantastic way of bolstering the chances of your trade being successful. So instead of just highlighting presence of one technical element and jumping into the market. All you're doing is being a little more strategic, a bit more conservative, potentially taking a little more time and taking a look at what else is in the market to suggest what might the next move be. Okay, and so this is a really great example then, and is a really good process for showing you how you can take a look at these, how you can view rather these patterns in the context of other technical elements that are presenting themselves on the charts. Okay, so that's the bearish version then of the 5-0 pattern. Let's now also take a look at an example of the bullish version, and you can see this time that the pattern starts, like we said in the diagram. So the pattern starts with a big bearish move from the 0 to the X leg. We then get a small retracement higher, giving us our XA leg. And then from here, we make another darting move lower, trading down below the low of the XA leg to put in our AB leg. Okay, so once we've got this move in place, we then want to draw an extension onto the AB leg and watch as price trades higher, and you can see that price trades all the way up to the 1618 extension of that AB leg before moving lower again. And then you can see the pattern finally completes into the 50% retracement of the BC leg, and again we've got that symmetrical move between the AB leg and the CD leg completion. So again, because this is the bullish pattern rather, once the pattern completes at this point into the D point this time, we can look to buy. So this is our buying zone. Now this is actually a really great example to use for educational purposes, because you can see here how the pattern presents itself slightly differently to how we were looking at on the diagram. Okay, so the diagrams we consulted, as I say, they're very specific, very neat, and they show the price moves very smoothly to identify the 5-point structure. However, you can actually see that the real price movement here in this pattern is particularly choppy. So the move we get from B to C isn't a straight line move. We actually go up here first, back down, we chop around here twice, almost breaking back down below the B point. So we're struggling to get above that resistance at A before finally price breaks out and trades all the way up to this C point. We then trade back down, and look how choppy the move is around the buying zone at D. So we don't simply touch the completion point at D and then reverse and explode higher. You can see we trade back down to this level, and then we stall, and we're chopping around before we actually do in fact break higher and break back above that C point. So this is a really good real life example of how these patterns can present themselves slightly differently in terms of real price action compared with the diagrams. But as I say, if you're spending the necessary time studying the charts, consulting your diagrams, and practicing identifying these structures, then very quickly you'll become very competent at picking up on these patterns, and it won't matter if they're choppy or not, because all you're really doing is identifying swing points, drawing in Fibonacci extension tools and retracement tools, and waiting to identify price moving into these levels to identify the pattern. Okay, so this is a really good example then, as I say, to show us what the patterns look like. Okay, so let's now take a move forward, and let's look this time at the one-to-one pattern. Okay, so essentially what we're looking at here then is for an initial move in price. So we're looking at the bullish version first of all. Okay, so we're back to these beautifully drawn diagrams, which hopefully you can understand and follow along with as I explain them. So the bullish one-to-one then, what we're looking for first of all is an initial move in price from X to A, a retracement lower, giving us our A to B leg, which completes into 61.8 to 78.6% retracement of the X to A leg. And then from this point here, we get another move higher, breaking above that XA leg, trading all the way up to give us our B to C point. And then we get one final retracement lower, and this gives us our D point, and it needs to complete into the 50 to 61.8% Fibonacci retracement of the X to C move. Okay, so from the low all the way up to the C, it needs to complete into the 50 to 61.8% retracement of that move, and that gives us our D level, which, because this is the bullish pattern, is going to be our zone for buying. So once we see the pattern completing here, this gives us our area where we can look to buy. Okay, so looking across to the bearish version then, you can see that this time what we're looking for is a bearish move initially. So the pattern begins with a move from X to A. We then get a retracement higher from A to B into the 61.8%, 78.6% retracement of the X to A leg. And then from the B leg, you can see we get another move lower, breaking down below the X to A. And you can see I've actually forgotten to put in the C there, but if you can imagine, there should be a little C notation here. So once we've got our B to C leg, which is the penultimate leg of the pattern, we then get another retracement higher. And this time we trade back up into the D point completion, and this completion point needs to occur between the 50 to 61.8% retracement of the entire move from X to C. And then once we've got our D point completion here, because this is the bearish version of the pattern, this is our zone where we can look to sell. Okay, so these are the pattern parameters then. And when you're going through the charts and learning to identify these patterns, it really does help to simply either print off these patterns so you've got them on some paper next to you, or have them open on another monitor or screen, and you can simply look to monitor what you're identifying and drawing on the charts against how the pattern parameters actually play out in the diagrams. So as I say, because the measurements of this pattern are so precise and the structure is so simple, this is really one of the easier patterns, harmonic patterns, to identify. And where they do appear, they can be used to gain entry into trending markets really easily. So these patterns actually work particularly well in trending markets, and you can see why, because we're exhibiting that classic trend structure of higher highs and higher lows for a bullish pattern, and then lower lows and lower highs for a bearish pattern. Okay, so let's take a look on the charts then and see how these patterns present themselves. Okay, so here we've got our first bearish version. You can see here we've identified our X to A swing point. So we've got our initial bearish move. Price then retraces higher up into the B point, which completes at the 61.8% retracement of that X to A leg. So once we've mapped this initial move, let's imagine we're at this point in time here, so we can't see any of this. Once we've seen price retrace into that 61.8% level of the X to A leg, and then we start to move and turn lower, well, once price does start to move lower like this, then we can anticipate that we might have a potential one-to-one pattern on our hands. And then all we need to do is look to draw in our levels and monitor price as it starts to move into the other extension levels. And then another key thing which we can do is drawing in a clone of this line, drawing in this line to measure its size and then cloning it. And so once price starts to move, we can look to check if we get a retracement of a similar level. Okay, so if we look at how price developed, then we're going to move from X to A, retraced into, it was the 61.8% level of the X to A leg, and then we got our AB leg retracement. And then once that started selling off, we can go ahead and clone in our A to B leg. And then once we move down to this low point here and started to retrace higher, we can go ahead and put in our AB leg retracement, clone it, and watch and see what happens. You can see that the CD leg actually trades up and completes into the 50% retracement of that entire move of the X to C leg. So this is a classic example of a bearish one-to-one. And as I say, you can see here just how effective this can be in gaining entry into trending markets, because all we're looking to do is capture the retracement and then trade an anticipated resumption of the trend. So where we're selling at the completion point of D, then there are two ways again we can look to play the pattern. So as with the 5-0 pattern, we can look to trade a short-term reaction from the level, and then we can also look to trade a longer-term reaction, anticipating that a trending move is going to develop. So when we're playing for the short-term reaction, then we can place our stop simply above the next Fibonacci level. So if we're short at the 50% retracement, our stop goes above the 61.8%, and then we can simply target a move down into the 23.6% retracement here, which gives us a nice 2-to-1 return. Or alternatively, we can look to trade a move down into the C point here, into that C low. And remember, just like with the 5-0 pattern, wherever we have a pattern or a structure which includes a break of lows or highs, these levels tend to be the pivotal levels that can make or break your trade. Okay, so if we're short at D, we can anticipate that C is going to be the likely end of any short-term move. So the market might well resolve itself lower in the long run, but in the short term, this C point, this BC low, is likely to act as pivotal support. And you can see that if we were short from D here, we did in fact trade down into that C level and then reverse slightly higher. So this is a really good level where we can look to take our profit on that trade for a short-term setup. Now, alternatively, if we're looking to trade the pattern for a longer trending move and stay in it for a longer duration, then again, what we can look to do is place our stop a little further out. So where we're short at the 50% retracement, our stop goes above at the 78.6%, and then we're looking to hold the trade for a break below that BC leg low. So again, when we're trading the pattern in this way, we need to be aware of the fact that this BC level low is likely to pose support rather. And so once price trades into that level and we start to see any sort of reversal candlesticks occurring, what we can do is go ahead and move our stop down to break even, and this will protect us from any adverse moves that the market makes from here. But then what we're anticipating is that price is going to continue to break down below that CD leg low and move down to make new lows. And in terms of identifying a target, what we can do again is similar to what we were doing with the 5-0 pattern, which is where we clone the move made from B to C, and once we map that leg, we then clone it and place it from the D point here, and this gives us a projected level, which is a target, so a level equal from that move. Okay, so this is a really fantastic way of looking to identify a clear and appropriate target for these trades, because I know that a lot of times when traders are looking to trade trending moves or longer term moves, one of the places where they come unstuck is in how they actually identify a target. So it's fine to say you're going to let your trade run and you're looking to, you know, bank whatever 5 to 1 or 10 to 1, but in terms of actually exiting the market at a predefined level, that can sometimes be a bit tricky. And so it's really good to actually have a well thought out, clearly defined strategy for how you're going to exit the market, because you always have to exit the market at some point. Now, I know there are some traders who, once they identify a move like this, will simply look to stay in the market for as long as possible, and that's fine. But in terms of actually looking to bank your trade, then looking to use a target like this, cloning the move from B to C and applying it from the D point, is a really sensible way to trade and will give you a really good return on your move. So that's the bearish version of the pattern. Now finally, let's take a look at the bullish version of this pattern. So again, this time, our initial move, the XA leg, is a bullish move, and then from here we retrace down into the 61.8% retracement of X to A. Once we've made this retracement and price has started to turn higher, then we can go ahead and monitor price as it trades up. We can map this retracement here by drawing in our line and cloning it. And then as price trades up once again into this high point, so you can see we just about break above the XA high there, we then draw in our retracement level, and you can see that the market comes down and retraces right down into that level, just into the 61.8% retracement, just ahead of it. But you can see that the symmetry in that move is ideal again. Okay, so this is what we're really trying to understand. This is what I'm really trying to hammer home, rather, is that once you understand the symmetry and the ratios involved in these patterns, then looking to identify them on the charts becomes very simple. So all we're looking to do with these patterns is identify symmetry between the A and B and C and D legs, and make sure that that final CD leg completion occurs into the correct Fibonacci retracement area. Okay, so I hope that you've all enjoyed that session then. I know that we've covered a lot of material here, and with these types of structure, there's a lot of information to cover, all of the different parameters and the ratios and the different lines. But it really is a case of just learning the parameters, spending enough time studying the charts and practicing identifying them. And it honestly won't take you long until these patterns are jumping off the charts at you. And that's when you can really start doing some fantastic harmonic trading. So just before I wrap up then, are there any questions I can answer for anyone? Brilliant. Okay. Well, look, I'm really pleased that you've all enjoyed that session, that you followed along with the material. And as I said, just spend the right amount of time looking at these charts and studying these patterns and the diagrams. And it won't be long until you're picking them out with these, and then you'll be making some fantastic harmonic trades. So thanks a lot, everyone, for joining me today, and I look forward to catching up with you all next time. Take care, everyone. Thank you.